Financing your business, an introduction to financing options for your business. The course has 4 key objectives. 1. Review questions to help you determine your business's financial needs. 2. Identify the various financing options for your business. 3. Review available financing options. And 4. List the pros and cons of each of the financing options. The topics discussed in this course include determining your financing needs, equity versus debt financing, loans, grants, venture capital, angel investors, savings, retirement, and other investment accounts, crowdfunding, peer-to-peer lending, and family and friends. Let's get started. Despite having the idea and being good at entrepreneurship, it's often difficult to start up a business. Equity is the key element for a startup small business venture. You have to explore different financing options in order to provide added equity for your business to survive. Before you investigate the financing options for your business, the first thing you need to do is assess your current financial situation thoroughly. Often, this means having a solid business plan with 5 years of financial projections. You should not only know how much capital you need to get started or expand your business, but also know how your revenue stream will look in order to pay back any debt financing. Let's look at a list of questions that you must ask yourself to determine your financial needs. Do you need more capital, or can you manage with the existing cash flow? If you have trouble paying your obligations on time, you may need an infusion of working capital. What is the nature of your need? You should determine whether you need money to start or expand your business or as a cushion against risk. How urgent is your need? Whenever possible, it's better to anticipate your needs rather than have to look for money under pressure. It's harder to gain approval for a loan when your company is already in trouble, so plan ahead and secure financing well in advance of a crisis. How great are your risks? All businesses carry risk, and the degree of risk will affect both the cost of your loan and the financing alternatives available to you. In what stage of development is your business? Needs are generally more critical during transitional stages, startup and expansion being 2 of the most urgent and costliest stages. For what purposes will the capital be used? Lenders will need to know your specific intentions for the money to assure themselves that your business will thrive and that repayment is assured. What is the state of your industry? Whether your industry is depressed, stable, or fast-growing will have a distinct effect on your search for funding sources. Businesses that prosper in tough economic times will generally receive better funding terms. Is your business seasonal or cyclical? Seasonal needs for funding are generally short-term and consist of smaller loans with a quicker maturation. Loans advanced for cyclical industries, such as construction, are designed to support a business through depressed periods. These industries are sometimes known as feast and famine businesses, and the cash flow is often erratic and unpredictable. How strong is your management team? Effective management is an important element of business. Your lender will be looking for a strong managerial presence. How does your need for financing mesh with your business plan? All lenders will want to see a solid, well-thought-out business plan for the startup and growth of your business. If you don't have a business plan yet, make it a priority to write one. If you are planning to start a business, it is critical to determine your budgetary needs. Since every business is different and has its own specific cash needs at different stages of development, there is no universal method for estimating your startup costs. Some businesses can be started on a smaller budget, while others may require considerable investment in inventory or equipment. Additional considerations may include the cost to acquire or renovate a building or the purchase of equipment. To determine how much capital you need to start with, you must estimate the cost of doing business for the first few months. Some of these expenses will be one-time costs, such as the fee for incorporating your business or the price of a sign for your building. Some will be recurring costs, such as the cost of utilities, inventory, and insurance. While identifying these costs, decide whether they are essential or optional. A realistic startup budget should include only those things that are necessary to start a business. These essential expenses can be divided into two separate categories, fixed and variable. Fixed expenses include rent, utilities, administrative costs, and insurance costs. Variable expenses include inventory, shipping and packaging costs, sales commissions, and other costs associated with a direct sale of a product or service. The most effective way to calculate your startup costs is to use a worksheet that lists both one-time and recurring costs and can be found by searching the internet for terms such as startup expenses or startup cost worksheet. After identifying your financial needs, you must arrange for the financing. Thoroughly understanding the basic types of financing can reveal the options that might be most attractive and realistically available to your business. Typically, financing can be divided into two categories, debt financing and equity financing. Debt financing means borrowing money that must be repaid over a period of time, usually with interest. Equity financing means raising money in exchange for a share of ownership in the business. Debt financing. Debt financing is borrowing money that must be repaid. Repayment is done over a period of time and with interest. Lender does not gain an ownership interest in the business, and the loan is often secured by company assets and borrower's personal guarantee. Sources may include banks, savings and loans, credit unions, commercial finance companies, SBA guaranteed loans, state and local government programs, family members, friends, and former associates. Equity financing. Equity financing is raising money in exchange for a share of ownership in the business. Equity financing allows businesses to obtain funds without incurring debt or having to repay specific amounts within specific times. Sources may include investors such as friends, relatives, employees, customers, and industry colleagues. The most common source of equity funding comes from venture capitalists, a private equity investor that provides capital to companies exhibiting high growth potential in exchange for an equity stake. Venture capital is discussed later in the course. To furnish the costs, you might need to look for credit for your business. Your credit history is the first picture you will give your prospective creditors on why you should be considered for credit. When a small business requests a loan, one of the first things a lender looks at is personal and business credit history. So, before you even start the process of preparing a loan request, you want to make sure you have a good credit history. Request a copy of your personal credit report from credit bureaus such as TransUnion, Equifax, or Experian. You should initiate this step well in advance of seeking a loan. Personal credit reports may contain errors or be out of date, and it can take 3 to 4 weeks for errors to be corrected. It's up to you to see that the corrections are made, so make sure you check regularly on the progress. You want to make sure that when a lender pulls your credit report, all the errors have been corrected and your history is up to date. If you have been late by a month on an occasional payment, it probably won't adversely affect your credit, but it's likely that you will have difficulty obtaining a loan if you have unpaid collections or are continuously late in paying your debts, have unpaid debts, unpaid liens, have a judgment against you, or have declared bankruptcy in the last 7 years. Beyond credit history, another important thing that lenders consider while deciding whether to offer your business a loan is the amount of collateral that you have. Collateral is an additional form of security which can be used to assure a lender that you have a second source of loan repayment. Assets such as equipment, buildings, accounts receivable, and inventory are considered possible sources of repayment if they can be sold by the bank for cash. Collateral can consist of assets that are usable in the business as well as personal assets that remain outside the business. You assume that all assets financed with borrowed funds will be used as collateral for the loan. Depending on how much equity was contributed by you towards the acquisition of these assets, the lender may require other business assets as collateral. Your home or personal assets may be considered collateral based on one of the following criteria. The lender requires the residence as collateral. The equity in the residence is substantial and other credit factors or sources of collateral are weak. Or you operate the business out of the residence or other buildings located on the same parcel of land. There are two types of debt financing: short-term financing and long-term financing. Short-term financing can be in the form of an overdraft, a letter of credit, or a short-term loan. Long-term financing can be in the form of long-term loans or leasing. Short-term financing can be in the form of overdraft, letter of credit, or short-term loans. The term period for short-term financing is generally less than 1 year. Such financing provides you with quick ways to get liquidity. It can help you fulfill small economic needs and also allows your business to capitalize on opportunities. However, short-term financing has higher interest rates and in general doesn't fulfill long-term capital investment needs. Long-term financing can be in the form of long-term loans or leasing. The term period for long-term financing is more than 1 year. Periodic repayment is generally the mode of payback. Equipment that is costly can be taken on long-term lease, which a business can eventually buy out. Long-term capital needs can be fulfilled through long-term debt. Long-term financing provides stability, but the total interest paid over a long time is higher. The types of debts or loans available to you and the terms of those loans will typically be determined by your business organization scheme, whether you are a limited liability company or an organization of some other kind. So, if you are not an incorporated company yet, you might want to think about the type of incorporation that is best for your company, considering the type of financing you expect to get. Talking to a lawyer or your bank's loan people might help you in this regard. SBA offers a variety of loan programs, including 7A Guaranteed Loan Program. The 7A loan program is SBA's most well-known and widely used loan program. This loan program provides loan guarantees for small businesses that cannot obtain financing from conventional sources. Facts of the 7A loans include: SBA provides the guarantee for lenders to make loans to for-profit small businesses. The loan proceeds can be used to start, acquire, expand an eligible small business, purchase real estate for the business, purchase equipment, inventory, or supplies, and for working capital. Depending on what is being financed, the loan repayment period is up to 25 years. The maximum loan amount under 7A is $5 million. Loans are made by SBA-approved lenders using the specific rates and terms permitted in the 7A program rules. Visit SBA's 7A loan program for more information about the types of 7A loans available to small businesses. Traditional banks can be another source from which you can get a loan for your business. Though traditional banks sometimes tend to be more favorable for A-credit businesses, you may also try to get their assistance. The turnaround time for a loan from a traditional bank might just be on the longer side, but the interest rates are mostly on the lower side. It's worthwhile to check with traditional banks as a source of loans for your business. SBA microloan program can be another viable source of loans for your business. The microloan program provides loans up to $50,000 to help small businesses and certain not-for-profit childcare centers start up and expand. The U.S. Small Business Administration provides funds to specially designated intermediary lenders, which are nonprofit community-based organizations with experience in lending, as well as management and technical assistance. These intermediaries administer the microloan program for eligible borrowers. The eligibility requirements are different for each intermediary lender. Microloan proceeds can be used for working capital, inventory, furniture, or equipment, but not for paying existing debts or purchasing real estate. The maximum repayment term for an SBA microloan is 6 years, and the interest rate is between 8 and 13%. Apart from loans and grants, there are other financing options for your business. Let's look at each of them. Venture capital is one such important source of financing. It is a type of equity financing that addresses the funding needs of entrepreneurial ventures which, for reasons of size, assets, and stage of development, cannot seek capital from more traditional sources such as public markets and banks. Venture capital investments are generally made as cash in exchange for shares and play an active role in the company invested in. In 1958, Congress created the Small Business Investment Company (SBIC) program to facilitate the flow of long-term capital to America's small businesses. SBA does not provide capital directly to businesses. Instead, SBA partners with private investors to capitalize professionally managed investment funds, known as SBICs, that finance small businesses. The structure of the program is unique. SBICs are privately owned and managed investment funds. They are licensed and regulated by SBA. They use their own capital plus funds borrowed with an SBA guarantee to make equity and debt investments in qualifying small businesses. The U.S. Small Business Administration does not invest directly in small business through the SBIC program, but provides funding to qualified investment management firms with expertise in certain sectors or industries. And your small business can get venture capital investments from such SBICs. Going for venture capital investments in your business has its own pros and cons. The good thing about it is that venture capital, which you can raise, is money that you can keep. You don't need to repay or take account of interest rates. You don't need to attach collateral for raising venture capital. It can help your business grow quickly. Venture capital funding is generally committed and long-term. The flip side is that in return for the capital investment, the venture capitalist would own a stake in your business and might at times, depending upon the amount of investment, make controlling decisions. So, raising venture capital amounts to giving up a share in your business. It can be a cumbersome and lengthy process for you to find a suitable venture capitalist that is willing to invest in your business. Angel investors are another source of financing for your business. Business angels are high net worth individual investors who seek high returns through private investments in startup companies. Private investors generally are a diverse and dispersed population who made their wealth through a variety of sources. But the typical business angels are often former entrepreneurs or executives who cashed out and retired early from ventures that they started and grew into successful businesses. These self-made investors share many common characteristics. They seek companies with high growth potential, strong management teams, and solid business plans to aid the angels in assessing the company's value. Many seed or startups may not have a fully developed management team, but have identified key positions. They typically invest in ventures involved in industries or technologies with which they are personally familiar. They often co-invest with trusted friends and business associates. In these situations, there's usually one influential lead investor, archangel, whose judgment is trusted by the rest of the group of angels. Because of their business experience, many angels invest more than their money. They also seek active involvement in the business, such as consulting and mentoring the entrepreneurs. They often take bigger risks or accept lower rewards when they are attracted to the non-financial characteristics of an entrepreneur's proposal. Seeking angel investors to finance your business has its advantages and disadvantages. One of the advantages is that angel investors may provide you the needed capital right at the startup stage of your business. They generally agree to flexible investment agreement terms compared to traditional sources of funding. Angel investors, often successful entrepreneurs themselves, add business acumen to your venture. They may agree to invest in your business even if it is a risky venture if they like your idea. Angel investors are often ready to look beyond mere financial return. On the other hand, angel investors generally are not ready to make follow-up investments. They can be costly at times and want higher returns on their investment. An angel investor may often want to be involved in the decision-making process of your business, and you may virtually lose control. It can be a difficult task to find out angel investors as they usually operate behind the scenes. Your retirement account can be another source of financing for your startup business. You may have built up considerable amount of money in your 401k at a job or in your IRA, and now you want to start a business or turn your sideline venture into a full-time activity. You can use the money in your retirement account as capital for your business. You can roll over the proceeds from your retirement account to own a business. Rollovers as business startups, ROBs, are a way to optimize the use of money in your retirement account as a funding mechanism to start a business. It works if you have a 401k or other qualified retirement plan account with a balance that is sufficient for your funding needs and you adhere to the tax rules. You have to incorporate your new business and have that corporation set up a qualified retirement plan, usually a profit-sharing plan permitted under the terms of the plan to invest in employer stock. Then, you have to roll over your 401k or other retirement account to the new retirement plan. Note that the rollover is tax-free. That plan then buys shares in your corporation. For example, the plan becomes an owner of your business. Financing your business with your retirement account has its own advantages and disadvantages. The benefit is that by rolling over your retirement account into financing your business, you can avoid taxation on your retirement funds. Another benefit is that without bothering about your credit history, you can get access to necessary funds for your small business venture. The main drawback of using your retirement account to finance your business is that you are putting your life savings at risk. If the business fails to perform at the expected level, then you will lose your livelihood as well as your savings. Reverse mortgages and home equity loans can also be sources of financing for your business. You must be 62 and older to qualify for this type of mortgage loan. It is a way of converting the equity in your house into cash. The lender will pay you the cash, which you don't need to pay back as long as you are occupying the property. The cash needs to be repaid only in the case of your death or if you choose to sell or vacate your property. For more information about reverse mortgage loans, visit the Consumer Financial Protection Bureau. Home equity loans are funds that you can obtain through an encashment of your equity in the property that you live in. Unlike reverse mortgages, there is no specific age at which you qualify for a home equity loan. However, for this source of financing, you need to make regular repayments. The proceeds from a reverse mortgage or home equity loan are something that you can use to finance your small business. Another source of financing for your business is crowdfunding. Crowdfunding is a collective cooperation of people who network and pool their money and resources together, usually via the internet, to support efforts initiated by other organizations. Crowdfunding, as its name implies, aims to reach a funding goal by aggregating many small investors. Since the Jobs Act was brought into effect in April 2012, it has become easier for small businesses to raise money online via crowdfunding. Crowdfunding can now be used as an equity source in addition to the other forms of funding. The final rule was issued on November 15, 2015, referred to as Crowdfunding Adopting Release. Anyone interested in using this funding method should visit the Securities and Exchange Commission website to review the most current guidelines. Crowdfunding can give you access to financing for your unconventional business venture, which might not get funding otherwise. It also creates community awareness and publicity regarding your venture. The time involved in raising the financing through crowdfunding is relatively less than with forms of conventional financing. If you cannot hit the right chord, you might end up with no funds at all. If your crowdfunding campaign fails, your reputation may be harmed. There is also pressure to deliver at top speed. Your business needs to show positive results in a short time because the investors brought together through crowdfunding won't want to wait long. Peer-to-peer lending can be another source of financing for your business. Peer-to-peer lending, or P2P, essentially involves sharing your idea with other people in hopes that they will invest in your business. Sites like Prosper or Lending Club connect people who want to lend money with those who need to borrow, often in increments as low as $25. You determine how much you need to borrow, define the purpose of the loan, and post your listing online. In this way, if you find takers, you might have a source of financing for your business. Financing your business through peer-to-peer lending gives you the advantage of choosing from a host of lenders and settling for repayment terms that you feel will suit you. It also makes it possible to avoid the lengthy process of taking a loan from a conventional source. The disadvantage of this financing is that the terms of lending can often be vague, and the lender may have certain hidden terms of lending. You should check carefully before going ahead with this model of financing. Family and friends can be a viable and easy source of financing for your business. Entrepreneurs who lack a strong credit history or don't want the hassle of dealing with banks or private lenders often turn to family and friends to finance their business. Through family and friends, you can possibly get quicker access to cash with fewer hoops to jump through. However, on the flip side, if your business fails or you are tardy in repaying the money, you may be headed for some conflict with your family and friends. Here are a few pointers to remember while financing your business with loans from family and friends. You must carefully choose your financier. A financier with a bit of business knowledge will always help. Also, make sure to elaborate the risks and benefits of the investment to your financier. Even when securing financing from family and friends, you should have due diligence and passion for the business. It always helps. Instead of asking for the maximum, you should always be realistic and ask only for as much financing as you think is absolutely necessary. You must decide whether you want the financing from family and friends as a loan or as an investment in exchange for a share in your business. It's always good to have an agreement and repayment plan because, after all, it's a business transaction. We have discussed many of the financing options here. Still, a bit of research will always help you explore alternate options for financing your business. It's also important for you to perform due diligence about the lender's background and track record. This will help you choose the right financier for your business. You can also use the SBA's loan and grant search tool to locate a suitable financing option and financier for your business. That was a lot of information. Determining your financing needs will be your first step in looking for financing options for your business. In this course, you have learned how to determine your business's financing needs, identify various financing options for your business, explain available financing options, and list the pros and cons of each of the financing options. Now what should you do? Follow these steps to find a suitable financing option for your business. Step 1. Analyze the financial situation of your business. You have to do this to determine the financial needs of your business. You must arrive at the exact amount of financing that you need and the purpose for which you need it. Step 2. Create a solid business plan. It's the business plan and its viability that the investors are going to look at when you approach them for financing. Step 3. Evaluate the financing options that you learned in this course. Evaluate the pros and cons of each of the options and decide on the financing options that suit your business best. You can review SBA's Fund Your Business page on sba.gov. Step 4. Approach the investors. After you've decided on the financing option that best suits your business, you must approach the investors and negotiate with them to secure the investment. If you've decided on a loan, visit SBA's Lender Match, a free online tool that connects small businesses with SBA-approved CDFIs and small lenders. Step 5. Explore opportunities for growth. Once you have secured financing, you can concentrate on using it best to expand your business.